I'd like to now introduce you and give you a bit more detail on Thembeka and her journey. Thembeka hails from Johannesburg, has an honours degree in economics from UCT, and she joined M&G UK in 2018 as an analyst within our impact team. Since then, she's been promoted to portfolio manager on our diversity and inclusion strategy and is also responsible for the management of a number of our other social impact strategies. She was recently included on the winners list for Black Women in Asset Management 40 Under 40 and was named in the Financial News Rising Stars of Financial Managers in 2022. So with that, I'd like to welcome Thembeka to the stage.
Thanks, everyone. It's good to be with you this morning. So I'm just going to be walking you through our diversity and inclusion strategy, investing in companies that are demonstrating high levels of diversity, but also investing in companies who are providing products and solutions that are driving social equality in the communities in which they operate. Now, this portfolio essentially stemmed from our original M&G Positive Impact strategy, of which I'm also a deputy fund manager of. And since then, we have created verticals of strategies where we just look at environmental topics and also social topics, with the strategy being one of the main ones. So I think a good place to start, since we're on the topic of diversity and inclusion, is to really understand how the industry at the moment is looking. So whilst we've seen a lot of asset managers come out with, strong board representation from a gender perspective, where we've seen solid female representation from that perspective, the reality is when we dig down to more commercial roles within these organizations, the picture is perhaps less optimistic. So as you can see, outside of South Africa and also other key economies like the UK and the US, the amount of funds that are being run by women is still rather low, anywhere between 7 to 12%. And yet a lot of the companies that have been included in the survey have really stated how much, diversity and inclusion goals are a big priority for them. And yet less than 30% of them actually measure the progress that they are making towards these roles. Furthermore, in terms of the measurement of the outcomes from a diversity and inclusion perspective, whilst a lot of these companies might collect data on demographics, the reality is less than a quarter of them would also include pay discrepancies as part of that, which is a huge part of the gender pay gaps and the issues that women face in industry. And then when we look at the industry as a whole, mainly, looking at the FTSE and the S&P 100, that picture is pretty much still the same. Whilst board representation has increased, to around 30 to 40%, and that has largely been driven by regulatory initiatives, the reality is, again, when we look at more senior management positions and CEO positions, this remains quite low. And what we found from this is that within these large indices, the reality is 80% of these companies don't really report a gender pay gap. And of the ones that do, only 1% have reported not having a gender pay gap. So there's clearly a lot of work to do, and a lot of the problems that are occurring with the headline numbers as far as diversity and inclusion are concerned, and gender representation from a female perspective are concerned, a lot of them tend to be driven by the policies in the background and the lack of political will when these organizations look at diversity strategies. So why does diversity and inclusion matter? Well, the reality is previously disenfranchised populations such as women and ethnic minorities are actually growing their consumer spending power as well as their wealth across key markets. So for the US alone, you've got women comprising around 20 trillion worth of annual consumer spending. And that number is expected to rise to by around 40% in the next 5 years. Furthermore, in the UK, around 60% of the wealth is actually expected to be in the hands of women. And you're also seeing a huge growth of ethnic minorities in key markets such as the US, which is expected to become minority white in 2045. And so from that perspective, this really highlights the fact that it's important that companies better reflect the communities that they are serving in order to be able to preempt their evolving needs. And so diversity and inclusion is no longer being seen as a nice to have, but it's actually starting to make good business and strategic sense. And so for us, it's not a surprise that, when you look at studies such as the one Refinitiv has done, they've really unpacked the fact that culturally diverse boards of companies tend to outperform their less diverse peers. And then also of the small companies that don't have a gender pay gap, they have seemed to outperform their peers quite significantly. We also have supporting, reports from the McKinsey Diversity Wins report, which essentially says that companies that have greater gender diversity tend to outperform their less diverse peers by around 20%. Now, of course, if we're being cynical, it is always difficult to unpack exactly what the key drivers of performance are. But this at least shows us that it could not hurt to at least start to apply a gender lens in how we think about governance in companies. But one thing that's also important is understanding the social inclusion element. In order to create more diverse societies, it's important that people within communities are empowered. And so investing in companies that are providing solutions that can allow greater parts of the population to participate in the workforce also make economic sense. So for instance, if we're just looking at gender alone, there's about 160 trillion worth of human capital loss globally that's occurring as a result of women not being fully included in the workforce. And so that really highlights the fact that from a macro level, there's an economic loss to not having greater gender diversity. And even on a micro level, from a financial perspective for these companies, that's also turning out to be a factor. And so really by investing in solutions where we're not just looking at, empowering or investing in diverse companies, but we're also screening in companies who are creating products and solutions that can bring about greater social equality, you actually end up capturing around 40% of the UN SDGs. Clearly, the main ones would be SDG 5, gender equality, as well as SDG 10, reduced inequalities. But by also considering companies that are providing key infrastructure to underserved populations, or equitable access to affordable healthcare as examples, you start to screen in more of the social SDGs. And so that's why it was important for us to create that hybrid portfolio structure in which on one side, we have a sustainability fund that invests in sustainable companies that are also diverse from a gender perspective. And then on the other side of the portfolio, we can actually invest in impact or social impact companies who are creating products and services that are driving greater social equality within their communities. And by doing that, you're actually also able to create a portfolio that's well diversified, not just from a geographic perspective, which you see here, but also from an industrial perspective, as far as being able to invest across different industries. So we can invest in tech companies, industrial companies, healthcare, etc. And this creates a good balance as far as being able to create a high returning portfolio whilst also investing in diversity and social inclusion. And as you can see, for this portfolio, we're not just looking solely at gender diversity, but we're also tapping into ethnic minority diversity, which is something that is often overlooked, particularly in the developed markets, as well as that social inclusion pillar as well. So how do we go about, analyzing companies from a diversity and inclusion perspective? Well, ever since we launched impact funds at M&G in 2018, one of the things that became very prevalent or very important to us was the fact that we had frameworks that can allow us to be consistent in how we measure these companies and how we analyze the companies to be included in the funds, and also allow us to be able to balance capital returns and investing in good quality businesses with the actual mandate of investing in diversity and inclusion as well as social impact. So on the diversity part of the portfolio, we constructed a framework called the Equal Score, or the EQL. See what we did there? And E stands for ESG. That's where we actually go into the deep dive as to how a company performs from a sustainability perspective. It's important that companies are future-proofed, and performing in a sustainable way is a key part of that. Q is for quality. Now, that's where we go into the actual quality of the business model. We want to ensure that we're investing in companies that are built to last. And a big part of how we think about that is by understanding the moat that a business has. So this could be anything from its competitive position or the barriers to entry that the company has, as far as the scale, or even technology advancements that would be difficult to replicate. So as a result, there tends to be more of a quality bias in a portfolio such as this. And then finally, we have the leadership and diversity pillar. And this is, of course, what we're all here for. This is a deep dive into how a company is performing from a diversity perspective. Now, a key part of doing this is to first ensure that we're not just looking at high-level numbers, because we found that actually results in a lot of pink washing, but we're also trying to understand the policies and processes that are in place in these businesses in the background. So how these frameworks work is each company has to score above average for each of these three pillars to be included in our watch list. And that's really to ensure that we're not compromising the quality of the business model for the diversity mandate and vice versa. Both have to be evident. So now let's unpack that leadership pillar. What do we look at when we're thinking about these companies? Well, for each of these companies, we actually do quite a deep intensive 40-page analysis on how these companies are performing based on that EQL framework. And when we do the research on the diversity side, there are two ways in which we think about diversity. The first way is the diversity in numbers. So that's more of the quantitative elements of diversity, where we can look at the gender representation from board right down to workforce level. And then we try to understand the targets that the company has put in place in order to reach their diversity goals. This gives us comfort that if a company scores well from a representation perspective, that it will continue to do so over the long term, given the targets it's set in place. And then finally, it's around the pay gap reporting. Does the company actually do pay gap reporting? And how is it looking to reduce that pay gap over time? So this essentially helps us with also the initial screening of these companies, as we can actually use helpful tools like MSCI to understand how we can get the initial investable universe of diverse companies. And then on the other side, we'd look at diversity in practice. And that's more of the qualitative elements of diversity. Now, this is where we go into the policies that the company has in place. Are they built to create a more inclusive environment for women, as an example? We try to understand the reporting and the strategy around diversity that the company has. And then finally, how they've performed in the past and been recognized for their work from a diversity perspective. So again, by taking more of a holistic view, it reduces the chances of a company pink washing, and we're going to get comfort that the company will remain on the right track over the long term. A lot of the portfolios that we manage, we tend to take a 5 to 10 year view on. So this is important for us. So how would a company look based on that EQL score? Well, one of the portfolios, or one of the companies rather, that we have in our strategy is Bidvest, which I'm sure many of you are familiar with. And from an ESG perspective, we have seen a step change in how the company has been reporting on its ESG goals, mainly its plans to reduce GHG, water, and waste across its organization. So it's pretty solid from that perspective. Also, it's a very solid quality business, and that's because of the significant diversification it has, which is very helpful when you're operating in an economy that could be subject to macro political headwinds. And it has a solid moat in the scale that it has, and the fact that it has top 3 positions in most of the businesses in which it operates in. So given that, and the fact that it's also a good capital allocator, it actually makes a relatively good and quality business model. And then finally, from a leadership perspective, clearly from a gender diversity perspective, it looks relatively good, not just at board level, but down to workforce level. And they've also got progressive policies in place, which allow it to maintain that level of diversity going forward. I think the only caveat is clearly the board is quite heavily skewed towards women, which you don't really see quite often, but that becomes a good engagement point for them in order to create a better gender balance over time. And as you can see from this slide, or is this the right one? As you can see from the slide, it's possible to create a portfolio or to invest in companies that can meet the diversity criteria, that are sustainable in how they operate, and at the same time have a strong business model and can, as a result, generate value for shareholders. And this is the type of company that we'd invest in for a fund such as this. And so what framework have we adopted for the social inclusion part? M&G over the years has essentially come up with a framework for social impact companies called III, and it works in the same way as the EQL score. So on the investment side, it's really about the business model. The intention part is about understanding the intentionality a company has. We want social impact to be a big part of how they operate and a big part of how they make money. And then finally, you've got the impact. That's where we measure the impact that the company has generated over time for its community. One of the main metrics we might use is how it's reached the underserved population and how that's growing over time. And an example of a company that would be analyzed through this is Safaricom, which is also another holding within the fund. Clearly, from an investment perspective, it's quite solid as the largest telecos company within Kenya, and now also Ethiopia. And a big part of its mantra is how it can serve the Kenyan community. So intentionality is quite strong. And from an impact perspective, not only is it helping around 42 million people stay connected, but it's also that mobile payments part of the business, which is quite key from a social inclusion perspective, as it allows previously unbanked communities to have access to financial products in a world where they might not be able to have a bank account or even have a credit card. So it's clearly a strong candidate as far as how it's driving financial inclusion within the Kenyan economy, which has around 80% informal workforce. So this is clearly important for traders there. So when we think about diversity and inclusion, the reality is when we understand how a company is impacting its community from a social impact perspective, companies such as African telcos have actually done a good job in providing social inclusion for the communities. But a big part of that social inclusion actually involves empowering women. So around 60% of women in sub-Saharan Africa actually don't have access to financial services. So they're considered financially excluded. And as a result, having access to mobile payment systems has actually been transformative for that population group. And so there's a big part that these telcos are playing, not only from a general social inclusion perspective, but also in their abilities to screen in women through their products and services. But yet, when you look at the telcos industry, it continues to be significantly non-diverse, so rather male-dominated, with around a 33% gender pay gap and a lack of participation from women in this industry. And so one of the interesting things that these telcos have done, and Safaricom has been particularly strong at this, has been to identify exactly what were the barriers to entry to the telecommunications industry within Africa. And one of the key elements was an underpenetration of women studying STEM-related subjects. So as a result, they started investing in women from an early age in order to get that pipeline over the long term, and as a result, be able to draw from talent as those women graduate from those subjects. Another key factor was just safety. So a lot of the work that has been done is actually done at height. And also there were safety considerations regarding going to and from work, because a lot of the areas that are quite remote, which can be dangerous for women. So a big, thing that these telcos have been doing is actually improving the safety and security as far as transport is concerned, as well as the level of safety in the work that's been done. And that's been able to screen in more women in these industries. And so when you look at Safaricom, they actually have pretty solid representation of women at board, right down to workforce level. And they're one of the very few companies globally that have actually been able to reach a gender balance within their workforce. And this really highlights that even though a company might be generating some social inclusion from the products and services that they create, it doesn't preclude them from also understanding how they can drive greater gender diversity within their own ranks. And I think an example such as this really highlights that as well. And so finally, just to end off, the reality is, as much as we can invest in companies that we can view as best in class in diversity and inclusion, the reality is every company still has scope to improve, whether it's improving their disclosures around diversity and inclusion, or in fact, just enhancing diversity and inclusion within their ranks as well. And so a key part of our engagements every year is to really bring out a questionnaire to the holdings within the diversity and inclusion strategy to get a sense of how they're performing from a diversity perspective, not just from their headline numbers, but also from the policies and processes that they've put in place. So by getting this non-material, non-public information, we get a better sense of how committed these companies are to driving greater diversity and inclusion over time, or at least enhancing high levels of it. And so these are some of the results that we got from the holdings within the portfolio. So clearly from a representation perspective, based on the benchmark and global averages, the companies have done relatively well, achieving around 35 to 45% female representation from board down to workforce level. But a key part to this was the fact that when you look at the policies that they had in place, almost 2/3 of them had parental leave policies that were better than the statutory minimums. You also had around 60% of them, coming out with strong gender targets that they could work towards. And of course, flexible working has become key for a lot of women who want to sort of go through their parenting journey, but still be included within the working world. This has also been a good, game changer for people with disabilities as well, who can now perform their activities at home. So clearly, these policies have had a significant impact on the diversity and inclusion performance of the companies within the portfolio. And so to end off, there's probably the big question mark: how has the strategy performed versus peers? Well, the reality is what we found is by having a hybrid strategy, having that sustainability portfolio as well as the social impact portfolio, you can actually invest in relatively stable and commercial companies on the diversity side, but also tap into smaller, more nascent business model companies within the social impact side, which tend to be, emerging market or frontier market based or recently IPO'd companies. And a balance of those two company groups can allow for, a higher returning portfolio than peers who would just look at the 30% female representation at board level as a diversity criteria, and other social impact funds who can't invest in key sectors such as technology, for instance. And so that's what we found, has helped as far as creating consistent performance in a portfolio that's investing both in diversity and inclusion as well as social impact. So thank you so much for your time today, and I look forward to your questions in the Q&A section. Thank you.